and Team Kotak Mutual Fund. It's my pleasure to extend a warm welcome to Mr. Dhananjay Tikaria, the esteemed fund manager at Kotak Mutual Fund. We are thrilled to have him here with us today, as many of you know him in person, who is a helm of a Kotak MNC fund. We are eager to hear his valuable perspective on the fund's outlook, the market, and the opportunities in the global business landscape. So let's give a warm round of applause to Mr. Dhananjay Tikaria. And I would like to brief a short profile on behalf of Dhananjay. So Dhananjay is basically a senior vice president at equity research and equity fund manager at Kotak AMC. With Kotak AMC, Kotak Mahindra AMC since March 2008 he is working, and overall industry experience which he is holding is 14 years. And sectors and portfolio managed by him is telecom, capital goods, industrial, pharmaceutical, and hospitals. He is also pursuing a degree in PGDM and BTech. So let's welcome Mr. Dhananjay once again on this platform. Thank you, and over to you, Dhananjay.
Yeah, thanks a lot, Disha. Thanks for a warm welcome. Uh, uh, thanks to the team for joining on the call. Uh, we'll first have uh, I will go through the presentation. It's a relatively short presentation, say about 25 to 30 minutes, and then we would have ample time for Q&A. Right, I'll jump into the presentation. So, uh, is the slide visible for everyone?
Not yet, Dhananjay.
Oh, okay.
Also, do we have more participants or how is it? Hello?
Yeah. We are going live on YouTube. Awesome.
Okay, understood.
Yeah. Now your slides are visible. So just zoom it.
Yeah.
Thanks.
Yeah. Yeah.
Perfect.
Yeah. Thanks. So when we look at any thematic fund, what we want to look at is basically what kind of stocks this theme would invest in, would select, and what kind of portfolio we can expect from this team. So rather than focusing on the name MNC, we should look at what this team would do. So basically, what we look at this team as is as a filter for selecting good quality stocks. So basically, when we are able to do this well, what this team should do is should throw up companies which have businesses which are better in terms of quality compared to the broader index. Here, when we look at quality, what will mean is basically they have a business which grows in line or faster than the market. Then and the volatility in growth is lesser than the market. So basically it goes, but the ups and downs are relatively lesser, and return ratios and profitability are higher than the broader listed universe. So that is a broad idea behind using this theme and using this filter. So basically, when we look at this, look at MNC as a filter. So first question is what comprises an MNC. So here, what we have defined MNC as one. So there are two broad categories. One is where the parent of the company is a foreign company, and basically it's either a JV or a subsidiary. Means that the foreign company's ownership in the company is more than 26%. So either more than 26% or more than 51%. So basically one category right from 26% to 75%. Second category is domestic MNCs, which means basically Indian companies uh, for which the business outside contributes more than outside of India contributes more than 50% of revenues. So means so what we have added is basically an MNC. Either it is owned by an Indian company or it's an foreign company. So basically that's the broad definition. Now, why this filter for selecting quality stock? So basically, when we think about any MNC company, it means that this is operating in multiple countries, and if the company is doing well, then basically it's able to sell its products profitably across multiple geographies. What it would entail is that the company has the ability to sell products across the world, across many markets. So that means it has strong brands and strong selling engine which can achieve that. Second is basically it has the products, the quality of products which are considered good and are being sold across the world, so across multiple countries. Then third, it has the management depth to deal with the basically the challenges which come when you are operating in multiple geographies. So basically challenges can be in the form of having to ensure that the supply chain doesn't fail. So you have basically various problems like what we are facing, that now the supplies to Red Sea are getting obstructed. So basically now you have quickly find ways to supply from alternative routes to avoid any stock out situation. So basically the management should be able to deal with all those kinds of issues. Second is they should be able to deal with say currency fluctuations and similar challenges. So their management should be of that quality. Fourth is financial stability. So when you are operating in multiple geographies, then there are say challenges related to basically getting payments on time. Basically, you have to deal with your inventories, your client addition, and for that you need your balance sheet to be strong enough to basically deal with any kind of fluctuations which might happen or obstructions which might happen. So all these so when a company is operating successfully in multiple geographies, it would have all these characteristics. It will have strong brands, it will have good products, it will have quality management, and it would be more financially stable than the broader listed universe. So that is the core idea of using this filter. So if we use this filter, and then from the universe we get from this filter, we select good stocks, then we should be able to have companies which have all these characteristics. And it's very obvious that if a company has all these characteristics, it will grow, it will perform better than the broader listed universe. Now, when we'll go about say giving some examples in some instances about each of these trends, how these act, basically how these help companies to create more value or better value compared to the broader listed universe. So basically, when we talk about brand recognition, basically when we look at the leading companies around us and leading brands around us, what we find is most of the leading brands have been created by MNCs, because that has been because they understand in terms of what is the value of having a strong brand, and they focus on brand building from the start and continuously increase the focus. So basically, from what all companies we can see on the screen. So all these companies are from diverse sectors, and all these are these companies have the strong brands which everybody knows, and basically that is the strength we get from having companies from this MNC universe. So when we look at, say, just as a trivia, when you look at the top 10 most recognizable brands, 9 out of them have been built by just one company, which is HUL. And these they have been able to build, they have built over last many decades, and that is because the MNC companies continuously invest higher than peers in building the brand, and they are able to do it because of this brand strength. They are able to get premium pricing in the market. They are able to sell higher volumes, and some part of the additional profit they plow back into branding, and basically it becomes a virtuous cycle, and they are able to sustain this over a period of time, creating higher value for the shareholders. As an example of this, basically looking at Maruti Suzuki. So when we look at Maruti Suzuki, that though it was one of the first companies in India to make passenger cars, but it has still maintained predominant market share despite entry of numerous new players which had deep pockets. So basically, other Japanese companies have come in, other Korean companies have come in. You have seen European companies come in. You have seen American companies coming, but Maruti has not lost significant market share because of the strength of its brand. Now on the product side, so the second part which goes hand in hand along with strong brand is basically strong products, and MNC companies are able to have better products because they invest significantly higher amount in product development and R&D. And again, the main reason they are able to do it here is basically because in a group the R&D is pooled. So when the entire basically the entire revenue from the world kind of gets pooled, and you have R&D spend from that. The overall amount which you can spend, which the group can spend in R&D is much higher, and that is what we have shown as an example that Siemens, which has been listed in India, so that spends a very small amount in R&D, basically does local R&D because its overall size of the business is smaller. But Siemens AG basically does significantly more amount as R&D, and the products which are made by Siemens AG basically is available for Siemens Limited to sell in India. Similarly for Abbott, similarly for Nestle. So basically, this allows these companies to tap into the R&D which is done by the parent, which that option is not available for domestic companies, where they have to kind of carve out the R&D budget from their own P&L in India, which is much smaller compared to the global P&L for these companies. And when we look at what kind of advantage this R&D it gives is basically apart from the regular say superiority of their regular products, in terms of when there is a drastic change in the overall business environment, this allows companies with higher R&D to kind of be ready for any big change in the working environment. So, for example, Cummins is known for making diesel engines, and when you look at it, so diesel engines are basically very closely linked to fossil fuels. And when we look at when we are in a scenario when we have to reduce carbon footprint, and entire world is moving towards carbon neutral future, then Cummins has been able to build engines with which can use flexible fuel, which can use multiple fuels, most of which are incrementally are green fuels. And second, they have also been able to build electrolyzers for making green hydrogen, and also they have built they have built fuel cells for using green hydrogen to generate electricity. So while their Indian competitors are far behind and possibly will not be able to catch up in the foreseeable future. So basically, Cummins remains relevant when the overall environment has changed significantly for them, and that is the reason why these companies are very resilient. And most of the MNC companies have been there for many decades, whereas many of the local companies or come and basically either wither away because of such drastic changes. Then another example will be Bosch. So Bosch makes fuel injectors for which are mainly used in diesel engines, and now with the decline in diesel engines, their business should decline. But they had been ready for new products which go into EV drivetrain, and that has allowed them to remain relevant going forward. Third is on the quality of management. So when we look at overall management, so management is the main force which basically drives the company, and there is huge difference in the outcomes when the management quality is much higher. So we can here what we have given example is names of four key managers which lead companies, good companies across sectors. Basically, but these four people have come from just one company, which is HUL. So that is the kind of management depth just HUL has. And this is just an example, and MNCs generally would have similar kind of depth across other sectors. So just one company has been able to give this kind of talent, where these people have come out and are leading great companies in other sectors. So we can get a sense as to what kind of depth the other MNC companies in general would have. And as an example, we have shown that what difference this has done to other companies. So JB Chemicals was a family-driven company. Uh, the growth it was growing at moderate pace with steady profitability. And in FY20, this was taken over by KKR, and KKR bought in top management from other multinational companies, and once this management has come, they have been able to turn around the growth has improved significantly, margins have improved significantly, and that has led to significant value creation for shareholders. And in terms of basically the presence of MNCs around us, so in when we look at overall number of sectors, so AMFI classifies broad overall market in 22 sectors, and out of these 22, in 10 of the sectors, one of the leading companies, basically one of the top three companies, is an MNC. So that gives the sense of the deep presence these MNCs have in our economy. And basically, looking at this dominant presence and the structural opportunity India is going through right now, structural growth. There is no doubt that these companies would do well, at least in the foreseeable future, because they are already dominant in multiple sectors, and India is going through a structural growth phase, both in both in consumption sectors and also in investment sectors. So basically, at this point of time, consumption is seeing growth because of steady increase in disposable income of masses. And second, investment sectors are growing because of significant infrastructure spent by government as well as capex by private sector to increase their capacity. So both the kind of sectors are growing at decent pace, and these companies, because they are leading companies in these many sectors, they should be able to gain from this growth and should do well in the foreseeable future. In terms of the financial stability, one key metric is that consistently the debt these companies have is significantly lower than the peers who are present only in one country. So that reduces the vulnerability of these companies to any kind of shock to their business, any kind of negative impact which comes to because of any reason. Now, why we should look at MNCs? So one is the reason which we just discussed, that since these companies are leading in multiple sectors, and India is going through a structural growth phase, these companies will do well. Second is, now there are further few tailwinds to this growth. One is that as India grows in size, these companies are becoming more and more important in their overall group. So when we look at, say, Nestle, Siemens, Cummins. So their Indian entities which were listed in India are becoming more and more relevant for the entire group, and this is leading to more focus from the global company, global parent, on the Indian entities. So basically, as these companies are comprising a significant share of the incremental growth, because say US is growing at say 2-3%, China is growing at 3-4%, and so the entire the incremental growth, the significant portion of growth is coming from India, when India is growing at close to 7%. And then so what is what so this is driving all the global MNCs to give more technology, more products to Indian entities, and also add to their production capacity. So what we expect is that this trend itself is adding to growth in the for MNCs in India. Second is basically the trend of shifting of production from China to India. So what we have seen is China is in terms of size 4-5 times basically of the size of India, and basically their industrial base is even more larger. And when there is shift from any business from China to India, any even a small shift would be a significant size for the Indian entity. And we have seen this happening in multiple companies, where to diversify the supply chain from China to India, they have brought in products which were earlier exclusive manufactured in China to India, and this is further leading to increased growth. An example we've shown basically in Schaeffler, what we have seen is basically the size of the revenue of Indian entity compared to the global entity has increased from 4% to 5.5%. So increase of close to 40% in just 5 years. And this is in relative, this is a very significant growth. And in terms of that, is leading to basically more focus on localization in India, so that it becomes more competitive. And localization has increased from less than 70% to almost 76-77% in last 5-6 years. Now basically, why now, and how much beneficial this theme can be. So when we look at over last say 15 years, uh, Nifty MNC index has outperformed Nifty 50 by almost 3% on CAGR basis. And this it has done with a lower beta and lower volatility. So basically, while you are gaining from higher stock performance, you are gaining at a lower volatility. Means the falls which have been in between have been much shallower. So basically, the losses in between, which you can see in your portfolio, has been much lower. So this adds from both ways. It has been able to give better returns, and it has reduced the risk to your portfolio. Second is also and this we can further see clearly in terms of whenever market has not done well over say a decent period of time. In that period, MNCs have fallen less and have outperformed the broader market. So basically this ties in well with and this reinforces our thought process that these MNCs, the companies which come out of this MNC filter are quality companies, and because they are quality companies, they are able to hold on to their multiple better than other companies. So this comes to one concern which we get is basically in terms of the multiples. So and the premiums which these companies enjoy. So because these companies say grow at broadly the similar rate or slightly higher rate compared to the broader market, but they have higher profitability and lower volatility, these companies trade at a premium. So over a long period of time, what we have seen is that premium is at about 36% to the broader valuation. But what we think is that this premium is justified because of the positive value it adds to the portfolio by giving better return and also giving protection to the portfolio in times when the market is not doing well. Uh, Also, one reason for premium is also the scarcity. So compared to other companies, MNC company, we see very few fresh issuances by MNCs. So incremental opportunities or incremental shares are much more limited for MNC companies, and this leads to a scarcity premium. Now, where we as fund managers, active fund managers, would add value to this theme is basically we will look to avoid instances when the interest of the management does not coincide with the interest of the minority shareholders. So what we have seen in few instances is basically like when the parent wants to take money out from the Indian entity, they would increase royalty. That would so that we want to that would reduce profitability in the Indian entity. That would be negative for the minority shareholders in India. So similarly, when a parent basically does business through an unlisted fully owned subsidiary, then basically the opportunity which should have come to the listed entity reduces. So in those instances, we will avoid and look to not be in those stocks. as if these kind of instances happen over a period of time, these stocks do not create significant value for the shareholders. So that ways we can avoid being in stocks which would do kind of say which would have inferior performance compared to the other MNC stocks. So this is where we can an active fund manager can add significant value to the portfolio. Now, basically on the fund, on the basics of how the fund would operate. So first is we will make an investment universe based on the two criteria which we discussed at first, which is companies owned by foreign parents or Indian companies with more than 50% of sales coming from overseas. So currently, our universe, which we have already made, has about 153 stocks. And all of these stocks are these are all these stocks are under research by our internal research team. So there are few other stocks which qualify the criteria, but they are not part of universe because they are not under coverage still. So gradually we will. So what we expect is that we should be able to get these stocks also in coverage, and the universe should expand. We are not having any kind of a market cap bias or a sectoral bias. So basically, this will be market cap agnostic fund and a sector agnostic fund. So why no market cap bias is because what we think is that for the size of the fund, we should be able to have adequate liquidity even if we invest in small and mid cap stocks. So because since this is a thematic fund, we don't expect this to be say in size comparable to say large diversified funds. So in that case, if few stocks are say mid cap or we have significant presence in mid cap and small cap, it should not it should not be challenged for liquid for from the point of view of liquidity. Second, so hence we will use a bottom-up stock approach. We will look at, say, once we will look at the entire, scan the entire investable universe and look at stocks with a favorable valuation commensurate to the growth these stocks are offering. Basically, when so basically our house philosophy is GARP. We try to find growth stocks, but we also have a sense on basically what kind of what kind of valuation we are paying for these stocks. We will not be kind of just looking at growth and kind of willing to pay any price. So we will look at both the growth and valuation and try to maximize the growth for the valuation we are paying for the portfolio. Uh, so our benchmark would be Nifty MNC TRI, and the fund manager would be Mr. Harsha Upadhyay, who's who's our CIO, and I'll be the co-fund manager for the fund. So that's broadly a small presentation on the fund. We can open the floor for questions. We'll be happy to answer any, give any clarifications on any questions anybody would have.
Thank you once again, Dhananjay, for the crisp and very precise presentation. I'm sure all our partners have taken their takeaways, and we are surely very convinced about this NFO and will surely participate with a great amount of ease. So let's move to our another session, which is Q&A. So I would like to present the questions on screen, which I've received from few of our partners. Just give me a minute.
Yeah. Okay.
Is it visible? So I'll just read out for everybody's convenience. Yeah, so my first question to you is, what is the investment objective of the MNC fund and how does it differ from the typical equity fund? So I think somewhere in these slides you have explained this, but please touch upon for everybody's understanding.
So basically, the investment objective is to have a portfolio of stocks which has higher quality than the broader diversified fund. And here, quality would mean that they have better resilience, and they have lower kind of volatility in their earnings and their growth. So that is the key objective, to have more quality names. And when we look at quality, the operative word is that there is more visibility on growth and earnings for these companies. Uh, so basically, when we look at a typical equity fund, what they try to maximize is basically on the growth part. Here we would also have significant kind of focus on the resilience of the fund. So basically, this will be slightly less aggressive than other thematic funds. More focus be on growth, which might be moderate, but the visibility on the growth will be much higher. So that is the core difference and the investment objective.
Yeah, thank you, Dhananjay. Moving to next question. What are the key sectors or industries where the fund invests, and how do MNC dominate these sectors? What's your take
So
on this here? Yeah.
So basically, when we look at key sectors, so in the universe, the sectors which are present predominantly are consumers, and in that we have both consumer staples, consumer discretionary. Then you have capital goods, industrials, and basically consumer discretionary cap goods. And also, when we about what we have added through domestic MNCs, we add two more significant sectors, which is pharma and IT. So basically, you have significant presence in, say, in these 5 6 sectors. So again, to repeat, basically consumers, both discretionary and staples, cap goods, then industrials, then then also a significant presence in chemicals and other industrial supplies. So there are multiple companies in those space. Then you have pharma and IT. So this allows to make a balanced, decent portfolio. What is not there also is, so we don't have any presence, or very minuscule presence in financial stocks, and also in utilities. So there is very little presence in those segments. How do MNCs dominate in this sector? Uh, so when you look at consumers, both discretionary and staples, the key strength which these companies have are the brands. So the companies are able to build these companies have the strongest brands they have built. So when the defining criteria for success is building strong brands, so MNCs clearly dominate. Similarly, on the cap good side, the clear domination is basically quality of product. So where these companies dominate, because they are able to invest continuously in R&D. Similarly, on the pharma and IT, so what is done is, Indian companies have now become leaders in manufacturing quality pharmaceuticals at a very reasonable price, and India has become the pharmacy for the entire world. So this is a clear advantage which these MNCs have. So because they get scale, when MNCs are supplying across the world, they have significant scale, and this allows them to again have create. This allows them the ability to beat everyone in terms of cost or cost of producing a quality medicine. And similarly on IT again, because of scale, Indian companies are able to kind of beat the competition because of overall innovative service offerings they bring in, which basically is very competitive and is of high quality, and they are able to service across the world. So that is the key advantages in these key sectors which these companies have.
Agree, agree. Thank you, Dhananjay, once again for the brief answer, and I'm sure you have brought a clarity to our investors. Moving to our next question. So, how does MNC fund manage risk, especially considering the global exposure of multinational companies?
So when we look at the portfolio, when at the portfolio level, so the kind of risk these companies are exposed to is basically in terms of one is on the supply chain. So, is there do does the supply chain have risk of disruption because of various geopolitical events? Second is basically on the financial risk of operating across various geographies. So, can the business get disrupted because of any event? The way to manage risk is to continuously track the operations of the company, and basically continuously get updated in terms of what is happening to their operations. So basically, the only way to manage this risk is to have the complete understanding of their operations and complete understanding of the risk factors which go in with these operations, and that is the job of the research team and the fund manager. So basically, they day in and day out, they are looking at their portfolio companies and trying to figure out if there is anything which can go wrong. And whenever they get a sense that there is any kind of negative impact which could come through, then they look to kind of either reduce their position, or basically trying to find as to when the situation will get abated. So basically, again, there is definitely risk from global exposure, but the only respite to that is basically on from the research. Fund managers and analysts have to continuously understand better from the companies and understand about the operations of the companies, and basically avoid situations when the operating environment kind of becomes very challenging, and could lead to basically impact on the returns. So that is the only way to do it.
Yeah, thank you. Thank you, Dhananjay, once again for the precise answer. Moving to next, what are the key factors driving the growth and potential return of MNCs, particularly in emerging markets?
So key factors for growth is, so one is the domestic growth we are going through. So the domestic market itself. So basically, our GDP growth is about 7%. Then basically on that you have around 4-5% of, or even slightly higher inflation. So the overall your growth rate, nominal growth rate would be say about 12%, 13% odd. So that is the base case growth for a company, which should be there, say in a slightly long frame of time, basically 2-3 years. That should be the growth the company should be able to do. Better companies would grow slightly faster. So that is the key factor for the growth. Now, basically, on the other thing, when we look at the second part of the our our investment universe of which is of Indian companies which are getting more than 50% from other markets. There the opportunity is coming from Indian companies now getting into more challenging areas, becoming more and more competent and grabbing share from the global market. And the thing is, the opportunity is huge. Even though India is now close to say, or say more about more, slightly more than $4 trillion dollar as a market, overall size of trade, basically which India does to the world, is still say I think only say only 2% or so. So India, there is significant kind of growth which can come with only a minuscule improvement in market share or in global trade for India. And that is the opportunity for the companies which are doing business overseas, which Indian companies doing business overseas. They become slightly more competitive. They can grab a significant portion of this global trade, and that can have significant or steep effect in their growth. So basically, those are the key factors. One is your domestic growth, which is very healthy, and second is the opportunity in global trade. Yeah.
Yes, thanks Dhananjay for bringing the clarity on this question. Moving to next, how does the fund balance investment in established global MNC versus upcoming or high growth MNCs?
So here again, the key factor would be the valuation of for the growth we are paying. So basically, just to give an example, if a company is say kind of growing at say 15%, and say but trading at say PE of say 60 or 70, whereas there is another company which is growing at say 13% or 12%, but trading at a PE of 35. So basically, we would try to take a balance, and basically we might be better off buying a company with a slightly lower growth but a significantly lower PE, so that the risk on the overall portfolio is lower. So basically, the balance here would be on the valuation what we are paying for these companies. So we will look at growth. We'll try to optimize growth, but also have a filter in terms of what kind of valuation we are paying. So that would be that would be the key criteria for kind of choosing the companies, and basically that would be the key criteria for having a kind of split between global MNCs and established MNCs and high growth MNCs.
Yes, thank you for sharing your view on the same. My second last question to you is, what are the diversification benefits of investing in MNC and how does the fund contribute to portfolio stability?
So basically, the key advantage is that it provides significant support to the portfolio when the market is kind of not doing so well. That is the key advantage. Basically, your so what we have seen also in one of the slides in the presentation is that the market does not do well, these companies have always these stocks have always outperformed, and over a period of time they give slightly higher returns than say the broader index. So basically you get a benefit of having decent growth, but in times when the market is not doing well, this will provide stability to your portfolio. So that is the key strength.
Yes, thank you, Dhananjay, once again. And my last question to you, which I have received in the chat box. So, due to conflict in Asia, please suggest what funds we should buy to take advantage of this crisis period. Is MNC also a good fit into it? What's your take on the same?
So basically, when we look at this crisis and the impact which will have which we'll have in the world. So basically, so there will be short term. So short term impact is not generally positive, because what it will lead to is for increase in costs. So basically, there is disruption in traffic from the Suez Canal. So this will lead to basically higher costs if the ships have to kind of go via a longer route from this Cape of Good Hope. So basically,
Yeah.
that is the negative impact. Second would also be that the supply chains, if basically any companies are kind of using components which are coming from the companies which are involved in this conflict, then there are significant chances of that getting disrupted. So in the short term, the impact is expected to be negative, right?
Mhm. Yes.
For so there you have to avoid for these
Mm.
companies. So or you have to kind of sail through, like in terms of if the freight costs increase, then generally you have no option but to bear with it, because
Absolutely.
that would impact the margins. So, but it will be kind of, what we hope is it's a short term event. Maybe in couple of quarters this will abate. Second is on the long term impact. So long term impacts might be positive. So one is that because of these issues, if the supply chain gets impacted, what most of the companies try to evaluate is, can this product be made in India? Right, and you kind of reduce the risk. So what we have seen in many of the companies, if the product is large enough, then they try to indigenize and have local production. So in that case, there would be positive impact, and the companies become more competitive. So then you look at basically what India imports from these companies, and look at and the companies which import those products, which companies which manufacture those products. So then that can open up new opportunities for investment. So what I expect is, in the near term the impact will be negative, but in the slightly medium to long term, you will have positive impact, because there will be more focus towards local production of the products which basically are get disrupted.
Yes, so thank you so much. With this, we are ending our Q&A session. And on behalf of everyone here, I would like to extend our heartfelt thanks for taking out time and sharing your invaluable insights with us today. So your presentation on Kotak MNC Fund was not only insightful, but also gave us a deeper understanding about the product. So thank you once again. And I would like to address this to all our partners that this NFO is starting from 7th October and ending by 21st. So please participate. Do give your best in the same. And thank you once again, Dhananjay, for your time, wisdom, and making today's session a remarkable one. I would like to thank a Kotak team also, and thank you all our partners for the patient listening. Thank you once again.
Thank you, Disha. Thank
Thank
you
you.
for having us.
Thank
Thank
you.
you.
Yeah. With this, we are concluding the session. Thank you so much once again, everyone.